thrilled that we have today as our speaker the John Lipsky, the Peterson Professor of International Relations at SAIS at Johns Hopkins. And we're really pleased to be back in these quarters. Our chairman for many years was the chairman of Santander for North America, Gonzalo de las Heras, and we used this auditorium quite frequently during his tenure. And we're very pleased that we have added to our board recently Michelle Musali, who is the chief counsel at Santander, and we want to thank her and Santander for hosting us today. I am delighted that to formally introduce John Lipsky, we have someone who is following in his footsteps and someone who is currently the senior economist at JPMorgan Chase, at JPMorgan, I guess, Michael Hansen. So without further ado, I'm going to ask Michael to formally introduce John Lipsky.
Well, thank you everyone for coming. It's my pleasure to introduce tonight's speaker, Mr. John Lipsky. Many of you know John and his accomplishments well, so I will keep my remarks fairly brief. John has had a long and illustrious career in international economics and policy, a career split between the IMF and the private sector. He started his career at the IMF in the 1970s. In his decade there, he managed the fund's exchange rate surveillance procedure and participated in negotiations with several member countries, including as the resident representative to Chile in the late 1970s. John moved to Wall Street in the mid-1980s, joining Salomon Brothers and eventually becoming chief economist there. Riding the crest of the wave of mergers in the banking sector, he became the chief economist and director of research at Chase Manhattan Bank, and then joined my current employer, JPMorgan. He subsequently rose to vice chairman of JPMorgan Investment Bank. He returned to the IMF in 2006 as the first deputy managing director, where he was there until 2011. More recently, he's moved on to the role of educator and researcher, and he serves as the Peterson Distinguished Scholar at the Kissinger Center for Global Affairs at the Paul H. Nietzsche School for Advanced International Studies at Johns Hopkins University. Among his many other professional activities, John has served on the executive committee of the board of directors of the National Bureau of Economic Research and as co-chair of the Aspen Institute's program on the world economy. John earned his undergraduate degree in economics from Wesleyan University, where in fact I did once teach, although I never had the pleasure of John in the class with me. And he was trained as an economist at Stanford University. So please join me in welcoming John Lipsky to the podium tonight.
Thank you, sir. Well, thank you all. Oops, I should have. Can you all hear? This, I call this, it's a reverse Queen Elizabeth effect. If you remember her, yeah. But let's see. Can you hear me in the back? Okay, great. Well, thank you. And first I want to say thanks for a kind introduction. Thanks to Noel Latif and to the Foreign Policy Association for inviting me to give this Peter G. Peterson lecture, being the Peter G. Peterson Distinguished Scholar. I don't know about the distinguished, but in fact, I don't know about the scholar either, but it doesn't quite matter. It's my title. And I actually had the advantage of knowing Peter G. Peterson. And from a long time ago, back when I first came to Wall Street at Salomon Brothers, working for Henry Kaufman, got to know Pete and his concerns about fiscal policy that go all the way back to there. This lecture is about fiscal policy and national security, which I asked what exactly was that supposed to be, and I was told I could view that flexibly. And it seemed to me, as I was thinking about this lecture, I attended the IMF annual meetings in Washington back last month. I don't know, maybe I know some of you were there. I was quite taken, I must say at the time, with the gloomy atmosphere that seemed to pervade the meetings. The sense that the IMF's own assessment of global growth was that growth is weak, with significant downside risks, Of course, there was a sense of the building tensions on trade and of other sorts. And it struck me coming out of that if those downside risks do appear, that they create all kinds of risks in the current environment, financial, fiscal, and ultimately potentially security risks. But as I looked at things, the short-term outlook didn't really seem so bad, although it's obvious that things could be better. And it struck me that there was a lot of concern expressed at the meetings about the sustainability of policies, about whether the super accommodative monetary policy in most of the advanced economies was really appropriate or even effective at this time. Concern about fiscal imbalances, especially here in the US with our trillion-dollar deficits, and concerns that trade disputes, mainly between the US and somebody else. I mean, after all, there have been trade deals struck, for example, between Mercosur and the EU and elsewhere, but the US is embroiled in major trade disputes, of course, with China and also with the European Union. So it seems to me that in fact, when we think about the fiscal issues that certainly concerned Peterson for much of his latter years of his life, that those issues also are faced by virtually all advanced economies, and implicitly by China, whose demographics look more like an advanced economy than a developing economy, and face the risk, as you probably heard before, that they're going to grow old before they grow rich, and hence fiscal challenges all around. And the result was, of course, a sense that at this time, financial markets are performing in a way that is just too good to be true. And hence, let's call it a stew of risks that could be self-reinforcing if they began. So it seemed to me that it's worth thinking about what is needed to sustain the global expansion and avoid these risks, and whether that was plausible. Because after all, this expansion in the United States has already become the longest in our history. And you find lots of folks happy to tell you that if we look at the calendar, we're overdue for recession, and maybe dragging others with it, especially given our current policies of trade disputes. So that's what I want to talk to you about today. What is necessary to sustain this global expansion that, in fact, not only here but elsewhere has gone on much longer than I think consensus has held. And the points I'm going to make are really straightforward. I hope I'm not going to take that long to make them, and then hopefully we'll open this up and discuss some other aspects that I'm going to gloss over in my attempt to make a few simple points. The point I'm going to emphasize most of all is how critical it is that inflation remains low, that increasingly low inflation expectations have been built into planning and into financial markets and into policies, that if they were reversed, as you're going to see, or if the low inflation was reversed, we would see trouble appearing relatively soon. Another aspect that I think has been underappreciated is that, especially in the US, but not just in the US, as you'll see, real wages have been growing in the advanced economies, and hence the buoyancy of consumption. It's important that that keep going. Also, corporations have enjoyed exceptional profitability, especially here. We'll talk about for a minute what has buoyed that and whether it can be sustained. Finally, productivity, which has been a disappointment in the post-crisis period, finally appears to be improving. And sustaining that is also going to be important. Of course, it goes without saying that we need to avoid a recrudescence of the policy conflicts that have been plaguing us. I think many of us had hoped that when President Trump spoke at the Economic Club in New York 2 days ago, that he was going to announce progress in negotiations with China. He did say that it's close and suggested that it really is up to us, but then he also, I think, referred to the Chinese authorities in terms that are not, maybe in Queens, when you're negotiating, that helps you, but generally speaking, when you call your negotiating partner a cheater, not always conducive to agreement, but let's hope. There's a bunch of long-term challenges, obviously a fiscal challenge, but bound up in those are problems of inequality, problems of climate change that also are going to be important, but I'm not going to deal with here. Now, I brought along a bunch of pictures. I had hoped I'd be able to show them on a slide, and I could do a weather report and point, but maybe they'll be. I'd hope they would be useful in demonstrating what I want to say. So we can begin with the advanced economies' underwhelming expansion. The point's very simple here. It's commonplace, as the fund has, to characterize global growth as weak. And you can see, in fact, advanced economies are expected, and that I've added on the IMF's latest World Economic Outlook forecast, is expected to fall below the long-term average of just about 2.5% growth for the advanced economies. It's understandable why you would call that weak. Not only that, there's been, as you can see in the next chart, a very large divergence, what appears to be a large divergence in the post-crisis performance of the advanced economies. In other words, if we look in constant dollars, the Japanese economy's production output is only 5% above where it was at the end of 2007. In other words, that economy has hardly grown in 12 years. The European Union has barely grown by 10%, and we've grown by more than 20%. So things look very uneven. And when you look in the next page, the next chart at unemployment rates, at first glance you can say, well, that growth has been reflected in rather large divergence in movements in unemployment rates. In particular, the US rate has fallen sharply. In the early part of the crisis, we reached an unemployment rate virtually equal to that of the European Union, and today we're much closer to that of Japan. But I would think that that's in a way missing a point or a couple points of importance. Take a step back. Number one, that slow growth, that weak growth, has been associated with sustained declines in unemployment in all the advanced economies. In other words, maybe our vision of what is strong or sustainable growth, what is trend growth, may be outdated, perhaps by trends in demographics, among other things. In other words, that weak growth has produced substantial declines in unemployment everywhere. And when, again, take a step back and look at the graph and you'd say, well, they're sort of back, everybody's back to sort of their long-term bests. Not a bad performance. So it's also, and perhaps something many of you may have heard, but here it is in a picture, if you take a look in the next page, that rather seemingly large divergence in post-crisis economic performance has not translated into large differences in trends in per capita income growth. Demographics. There's substantial demographic differences between the US, Japan, and the European Union. As a result, as you can see, that rather substantial difference in real output growth is not reflected in anywhere near as large a difference in growth in per capita incomes. In other words, you could even make a case that it's really in that context fairly similar. Now, where there has been disappointment is on the next page. If we look at the emerging economies, and you can see they're just back to their long-term average. That long term is from 1990 to 2007. And in the early years of the 2000s, prior to the crisis, the emerging economies were substantially outperforming not only advanced economies, but their own long-term average. Of course, a lot of that was China, but not just. And now we're just back to long-term average. You can see that the IMF forecast anticipates a modest uptick in the developing economy, emerging economies growth, but that assumes they have incorporated rather favorable set of assumptions about India, about Brazil, about Russia, about Mexico. They're quite optimistic about the outlook for growth in most of the emerging economies, even though they have assumed a modest slowing in Chinese growth to just below the actual forecast for the coming year of the IMF is 5.8% for China. Main point here is the emerging markets' outperformance of their historical average has gone away. The advanced economies are, whereas they're not performing at their previous average, when viewed from the context of what has happened to unemployment and per capita income, are not performing anywhere near as badly as many people might think. Now, the IMF at the annual meeting stated, the risks to the baseline outlook are significant, or the way the fund likes to say it. The risks, the preponderance of risks are on the downside. As an aside, as a forecaster, that means it's not a fair forecast. Because if you make a fair forecast, the risk should be balanced. But the fund always, it's fundies. I've decided it's kind of congenital. The risks always are on the downside. I guess it's kind of if bad things happen and you hadn't warned, you're considered negligent, if not a fool. But if things turn out better than you expected, then people aren't, they're happy, they're not going to get mad at you. But when you look specifically at what the fund is saying are the risks, they name trade and geopolitical issues. Okay. Brexit, really? A threat to the global expansion? Okay. Financial vulnerabilities. Now that one sounds more serious. The trade stuff we've already seen. I mean, it could get worse, right? It could. But it's not like we haven't contemplated that. Financial vulnerabilities. That sounds more potentially serious, since equity markets are at record highs, the bond yields at lows, spreads. I guess this audience, I don't think I have to go through any depth in this. My question is, really, how threatening are these threats to the outlook? Well, when we look at the global purchasing managers indexes, which I've graphed here, you could say, well, that doesn't look great. No, it doesn't. But it really seems consistent with continued modest growth. It's not sending signals of an imminent downturn, but modest growth. And it seems to me that an aspect that has been overlooked in judging recent performance, especially in places like Germany, has been and in China for that matter, has been the rather substantial and sudden downdraft in the auto sector that has taken a notable chunk off of auto production in China and in Europe, and to some degree here. But globally, the downturn in units in last year was almost 10% in terms of total output of autos, which is pretty remarkable considering where we've been coming from. At the same time, the downdraft in energy prices has produced a stall in capital spending in the energy sector. So it strikes me in that context, unless you expect those things to continue to drain growth, these numbers look to me more like consistent with continued modest expansion. And I did, I guess I didn't include it, I've got it here. I should have included, it's a rather striking picture about what's happened in the auto sector. And I think people haven't taken that quite on board. It's non-trivial. But it's not necessarily likely to continue at declining at that pace. So there's, I think, a good reason to expect a better outlook. Well, I started out by saying that I thought continued low inflation, if anything was critical to being able to sustain the expansion and avoid the kind of circle or stew of problems that many were worried about, keeping inflation low is central. And this chart is may look a little hard to understand, but it's actually pretty easy. To the right of that vertical line, that blue line, that's unemployment lower than full employment, or what economists call NAIRU, the non-accelerating inflation rate of unemployment. Granted, this is not physics, and we could have a nice discussion about how you determine NAIRU in the US. Nonetheless, to the left suggests unemployment rates higher than NAIRU. So you would expect to see to the right of that vertical line, if you would expect to see accelerating inflation. To the left, you would normally expect to see decelerating inflation. But take a step back, the picture is obvious. There was a sharp increase in inflationary tendencies in the economy in the 70s that fell throughout the 80s and 90s and has remained very low and resilient through a lot of changes in the unemployment rate. Things just so far seem much less inflation prone than previously in the US. Is this sustainable or not is a critical question. And right now, I think we'd have to say we could discuss what's NAIRU, but with employment growth of only about 170,000, something like that per month, the unemployment rate is at least stable, may even be coming down. Previously, you would have thought that would have been not enough to keep unemployment level. So the labor force seems to be growing more slowly than it has in the past. Again, demographics. In the past, if you had had a 3.5% unemployment rate in the US, you would have expected accelerating wage gains and accelerating inflation. And it isn't happening. Could it happen? Of course. As I like to say, or I don't like to say, but admit it, one of the dirty little secrets of economics is that economists have a very weak grip on the process of price formation. We don't really understand what governs it. We can study it and recognize it, but predict it is harder than you might think. We're lucky because usually the best predictor of future inflation is the most recent inflation. And as long as it goes on like that, you're fine until you're not. But so far, it looks like the tendency has changed. And an example of that would be if we looked at inflation expectations, and I should say, I'm focused on the US, but it's not just in the US, obviously. This is in all the advanced economies. And Michael Hansen, who's introduced me, was a brilliant professor at my undergraduate school, Wesleyan University, has just published in the JPMorgan Weekly a very erudite study of inflation expectations around the advanced economies and suggested that they seem to be very low and well-behaved everywhere. So for now, so far, so good, but this is critical. Second, we've been a lot of worrying about why has productivity growth been so slow. And the simple, in the US and elsewhere, the simple approach or the simple version of that is all this talk about technology, where's the payoff? Where's the technology payoff? Well, these things tend to move rather slowly. And hence, I have for you on the next graph you can see the quarterly figures for productivity, and the press always announces them and people opine on them. My view is anybody who draws a conclusion based on a quarterly figure for productivity gains is begging to be made a fool of in public when those figures are subsequently revised substantially and your conclusion seems to be dead wrong. Usually you want to look at these over a broader period of time, much more reliable. That line, that yellowish line that I've got there is over 7 years. And what it suggests is it's sort of in line with what you might think, which is we had a big burst of productivity gains in the late 90s and early 2000s, that it was crimped substantially subsequently by relatively slow growth in corporate investment, and things seem now to have turned for the better. Can they stay that way? Again, a critical question. I would say that there's reason to believe, I think, that that U.S. corporations are doing a more effective job of incorporating technology in their production. We'll come to that in a minute. But the context I wanted to share was are we likely to see continued expansion in consumer spending, which is going to be critical for sustaining corporate investment? In other words, one of the disappointments in the U.S. economy recently, but not just the U.S., has been relative weakness in business capital spending during the past year. Is that going to be sustained or not? Well, if one would assume if consumption spending continues to grow at a relatively solid pace, eventually you would expect investment to come around, especially in the context of good profitability and low interest rates. So take a look and see what's happened here in that next slide that shows labor share of GDP, not just in the US, but in other advanced economies. I mean, you can see what's important. Interestingly, as you probably are all aware, that over the past decades, in the US, labor share of GDP fell to historic lows, which means that profit share was at historic highs. That's not true everywhere. As you can see, that in the Euro area and in Japan, the opposite was the case. But here and in the UK, labor share has been low. But the important point is look at the trend in all these cases, and that is labor share of GDP has started to increase over the past few years. Again, a sign that suggests that there are good reasons to believe that consumption can be sustained. And another aspect that bolsters that view is to look at what's happened to consumer confidence, which is on the next slide. Consumer confidence, not just here, but generally, is pretty high. And almost always, by the way, consumer confidence figures are dominated overwhelmingly by trends in personal income, by disposable income. There are cases when things happen, e.g. here, the Gulf War, that collapsed confidence and made a big dent in consumer spending, even though incomes were fine. Usually it tracks income. So the confidence, when you look at the labor share figures, when you look at wage figures, the confidence figures don't look ephemeral. They look sustainable. Okay. So the point here is that there are reasonable reasons to think that if inflation stays low, that positive trends can be sustained both here and in other advanced economies. Let's look to the financial side a bit. What has been perhaps the biggest surprise of the last few years? It's got to be the movement, the decline in sovereign bond yields, especially in advanced economies, especially in Europe and in Japan, as well as here. This graph, to somebody spent most of their career in the financial markets, is borderline unbelievable. that you have nearly 20% of the sovereign debt outstanding in the world trading at negative yields. I assure you, when I was taught economics, when Michael taught economics, this was never considered possible. It was like a theoretical idea. You never expected to see it, and on a sustained basis. But it's not just that. As you can see, that market expectations measured different ways suggest that most investors expect that sovereign debt yields are going to remain at 2% or lower for the future. I mean, the graph speaks for itself. This is absolutely unprecedented. It's more than unprecedented. It would not have been considered plausible just a few years ago. Hence, is this strictly a result of inflation? Unexpectedly low inflation? Is it a result of unexpected caution on the part of investors in the wake of the global crisis, that they want sovereign debt, they want safe assets at virtually any price? Is it because an aging population now values current income and reliable income rather than taking risks on capital gains? Maybe it's some of all of that, but it also probably reflects the action of central banks in their unprecedented quantitative easing and purchase of long-term debt in the U.S., in Europe, and in Japan. But this is one of the unsettling and unknown aspects of the outlook, in that you have such overwhelming expectations of continued super low long-term bond yields on sovereign debt. Certainly, that's another reason why I'd emphasize the importance of inflation staying low, because that's an aspect that is potentially vulnerable, namely that yields would stay so low. And here's where this comes together with the Peterson concerns in the short run. And that is, how is it possible that despite very high fiscal deficits, for example here, that government debt yields are so low? Well, one of the effects has been, you can see in the next chart, if you can hopefully understand, it's easy to understand, those bars show you sovereign debt to GDP. The line shows you the percentage of tax revenues that are required to cover the interest payments on that debt. So, miraculous dictu, for the advanced economies, actually the relative burden in terms of what percentage of tax revenues required to cover debt, interest payments on government debt has been falling despite the rise in deficits and debt. So hence the critical importance for sustaining these low yields for maintaining the sense of fiscal stability in the current context. Or another way, why has it been possible for us to finance $1 trillion deficit without any, not only perturbation, but in the face of declines in yields on long-term debt? This is critical for that. What's interesting, as I show you here, in contrast, for the emerging markets at best, the middle-income economies have not enjoyed the same decline in yields, and hence, despite their buildup in debt, which actually has been faster than in the advanced economies, they've been able to, let's say, hold their own in this context of the percentage of tax revenues required to cover interest payments. And for low-income countries, this has not been a favorable environment, to the contrary. So, hence, another reason why continued low inflation, continued confidence in the expansion is required to keep things going. But let's take a look. Are asset prices way too high? Well, every day this week, or no, maybe not every day. No, I think not yesterday. Oh, wait, yesterday we did hit a record. Day before we didn't. No, that's right. When the president spoke, we didn't hit a record high. Just saying. But obviously, it's a concern. You all remember Robert Shiller became a Nobel laureate thanks to writing books like Irrational Exuberance, that we all got crazy about asset values. Is that happening here? Is there a risk of a turnaround here? That, again, the big theme is, can we sustain these favorable these favorable short-term trends to avoid having to confront what we know is going to be some long-term challenges? Well, if we look at here, the next chart shows you U.S. stock valuations as a ratio to nominal GDP, record highs. Okay? But now let's take it in terms on the next page as a multiple to after-tax GDP profits. And the answer is, well, it looks good. Does it look anything like the era of irrational exuberance? And the answer is no. Is it obviously outsized? The answer is, well, it depends. And what it depends on, I think, is take a look at the next page. And that is clearly one of the important reasons why asset valuations, and here I'm just for simplicity concentrating on the US, but the tale is true elsewhere. Here this chart shows you, on the one hand, the market multiples, that's a yellow line. The light blue line shows you corporate profitability if you made the assumption that the very long-term post-war average of corporate profits at about 6% of gross domestic income were sustained. And the dark blue shows you the difference between that and the actual. So what it says is, in the post-crisis period, U.S. corporate profitability has been substantially higher than the long-term average. So another critical question is that sustainable or not? Is that real or not real? Is it a gimmick? Is it accounting gimmicks? Or is it the real deal? Because those are obviously, it doesn't take a genius to figure out if that excess profit, let's call that excess profitability, is ephemeral, then we have a problem. And I would say one of the critical issues to that is, are corporations, our businesses, more broadly corporations, actually making better use of, e.g., technology and other techniques to make higher profits sustainable? Open question, but a critical one. But the productivity figures that I showed you before at least provide a hint that suggests that this may actually be sustainable. Well, lest you think that this presentation has been a little too Pollyannish, saying actually there's reason to think we could keep this going, let me at least point out one area of potential concern, and that's the next page. And that is, if you remember, one of the factors of the global financial crisis that was debilitating and could have been really dramatically debilitating, that was the inability of foreign banks that had large-scale dollar assets to fund those assets because they had no native or natural dollar liabilities to fund those assets. They were borrowed in the interbank market to invest in U.S. securities. And when the interbank market turned pear-shaped and they were cut out, they were threatened with insolvency. A story that even today I find most folks either didn't know or don't remember. And that is, I could put this graphically and say, the German banking system would have gone poof in a cloud of smoke in 2009 in the in the freezing of the interbank market, were it not for the Federal Reserve's willingness to provide unlimited dollar swaps to the ECB that they could lend on to their banks so they could acquire dollars to fund their assets. Well, what's happened? We're back again because, why? Because the yields on US dollar securities are so much more attractive than in other markets. And the search for yield has once again led foreign banks, non-US banks, to make substantial increases in their holdings of dollar assets. And as you can see in that chart, branches and subs, you could assume that those are the parts that do have native access. Let's call it the native dollar deposits. The others would be vulnerable in a new crisis. It's interesting, on the next page you can see it's not uniform. That interestingly, UK banks and Swiss banks have cut back on their dollar holdings. Japanese banks and Canadian banks are the ones that have been increasing substantially of potential vulnerability in the context of a new crisis. So that's my story, and I'm sticking to it. The points were relatively straightforward and simple. It seems to me maybe a bit of the gloom that seemed to be thick on the ground at the IMF meetings has dissipated, I would say, somewhat in the face of reasonable news. But we can't take it all for granted. And the aspects that are required, in my mind, are listed here in reasonable order of importance. Most important, that low inflation is sustained. Important that incomes, that real wages continue to rise as they have been. Sometimes I think maybe the political rhetoric around here has been obscuring rather than clarifying what's really going on. Corporate profitability needs to remain strong, and capital spending, assuming consumer spending remains solid, should be expected to revive, in part because they've been obscured, what I claim to you is they're obscured, at least temporarily, by the sharp downturn in the auto sector and weakening in the energy sector. But critical importance is, again, as I showed you, the excess profitability, a result of more efficient use of technology and hence sustainability. But obviously, and would be remiss not to make the obvious point at the Foreign Policy Association that the threat of more severe trade disputes and uncertainty about policy has to have been a negative in the current context. And solutions that are acceptable to all sides, well, there won't be an agreement unless it's acceptable to all sides, that sustainable solutions would be another positive for the outlook. So there I am, and hope I've convinced you, but if not, let's talk about that and about anything else. You're very kind. Oops, well, I took longer than I thought. But, how do we do this? Just I'm the master of this thing. Sure.
Can you explain a little more your discussion about the
Yeah.
interbank overnight? Sure, I'm Mark Reed, I'm an economist from Raging Capital Research. I was wondering if you could explain a little more the graphs that were highlighting international exposure and dependence on overnight lending, and in particular, if that risk has any link to the recent overnight cash repo spike in September and again in October, how that balances out to overall risk.
First of all, just to say, these graphs are taken from, as they say in the footnote, from the Global Financial Stability Report that the IMF put out in October, and the issues they're dealt with a little more detail there. So if you want to take a look, I would recommend it. But if your question is whether the recent kerfuffle in the repo market here was linked to that, is that?
if you could go into a little more detail about those graphs, because I didn't fully follow what you were explaining.
Oh, okay.
That it's underappreciated.
Oh, okay.
And whether you thought there was any range.
No, I don't think so. No. Let's put it this way: nobody who is an expert on the subject has suggested that there was any linkage to non-U.S. banks in the repo market, the strains in the repo market. That the Fed officials have suggested that they consider this a little bit of a tempest in a teapot, that they've had some problems gauging liquidity demands, but these have been very short-term and non-threatening. And that's why they've gone to great pains to say that liquidity measures that they have taken to calm the repo market are not renewed quantitative easing. They're really just let's call it refining liquidity management. What I was saying here with this graph is the total foreign positions of these non-U.S. banks. The U.S. dollar positions are represented in that chart by the black line. Branches and subsidiaries are like we're in one. You can go upstairs, well, not now, and open a checking account in dollars at Banco Santander, right? Somebody here know whether that's a branch or a sub? I think it's probably a branch, right? Branch, yeah. They have their own dollar deposits. They have obviously dollar assets that respond to those. They took in the deposits and they lend them out, and it's a regular U.S. bank. Same for the subs. The rest are probably, the question is, where do you get the dollars to fund those dollar assets, that exposure? And typically those are borrowed assets. In other words, they're bought on the interbank market. And what happened back in 2008-9 was when the interbank market froze, a bank like JPMorgan has got, help me here, $1.5 trillion in deposits, in dollar deposits, and a gigantic amount of dollar deposits, and probably almost never ever borrows any, and just for tiny liquidity management. Whereas there will be foreign banks, non-U.S. banks, non-resident non-U.S. banks, offshore, buying dollar assets and borrowing the dollars to buy those assets. And what they're doing, of course, is trying to take advantage, and typically, of lower short-term rates and invest in longer term, take out a spread. But if they all of a sudden, as happened in the 2008-9, they got cut out of the market, they couldn't borrow at any price. They just would. The market was frozen. They had no way to cover those assets, so they had to find them somewhere. Where they found them was through the especially European banks. This was particularly true of European banks, especially German banks, had borrowed dollars, couldn't renew the loans, ended up getting loans from the ECB, that the ECB, which doesn't print dollars, had got them from the Federal Reserve. Is that the idea? Is that clear enough? Or were you asking something more detailed than that? And if you are, we can talk later. Yeah, ma'am.
Can you talk a little bit about the impact of these low interest rates that we have and these declining interest rates, its impact on our over $1 trillion deficit? And I don't know, I have a question.
Sure.
I'll have the mic, which is, I get a feeling lately that there's this jet stream of global billionaire money laundering scheme going around the world. And all the billionaires are involved with laundering their money somehow or another, and all those banks, Cyprus and Denmark and all of that. And the rest of us, we're just the plebeians making a living and investing in the regular stock market and paying our taxes. So what do you think about those two subjects?
The second one's really easy, but I'll come. What are low interest rates doing to our $1 trillion deficit? Making it easy to finance. They make it easy to finance. Make it cheap to finance. That's my point. As long as inflation stays low, things will stay under control. Never say never. But I would put it this way. If it started to look like inflation was accelerating and people began to think inflation was going to be accelerating, you would see a big change in markets pretty fast.
It can't stay like this forever, though. It's going to go up again, inflation.
Well, that's the question. I mean, that is the critical question. That's what I'm saying is the critical question. Suffice it to say that hardly anyone imagined that we would be where we are. I can assure you there are virtually zero professional economists who, if a couple years ago you had said, look, U.S. unemployment rate is going to fall to 3.5% and we're going to have $1 trillion deficit, what's inflation going to be? And I would say zero would have said under 2%. We're just in a place we don't know. Can it stay that way? Well, what I showed you is right now people expect that it will stay that way. And they're betting that they're going to stay that way. So I'm with you in the sense of if they're wrong, then we got troubles. Your billionaires laundering money. Yeah, there are billionaires who launder money. No, not all of them. This gets us potentially down a rabbit hole. Look at the Forbes 400. That's probably not very. When I lived in London, the London Sunday Times once a year published an edition that said the 100 richest Britons. 25% of the 100 richest Britons listed their occupation as landowner. Right? We know what that means. That means their great somebody did something really nice for somebody royal, right? And they're still some of the richest people in the UK. Go to the Forbes 400 and the only people who have inherited money are named Walton, I think. Everybody else has started something. They own a business, started a business. Many of them started businesses so fundamental we call them an industry. So those guys, it's hard to say those are money laundering.
That was the good part of what they
But there are plenty of folks. There are plenty of kleptocracies around the world where that's been going on, and that's one of the. Again, we're getting down a rabbit hole, but that's why there has been rather concerted efforts by the OECD and the G20 and the FASB, the let's call it financial regulators, to try to control money laundering, which used to be pretty easy to do, and today hopefully gets harder and harder. Yeah. And then,
Dr. Cole from United Nations and Kennedy School alum. My question has to do with our recent visit to the House of Parliament with the climate control people. We're at the Kennedy School. We're interested in the Brexit maneuver. I think that you noticed it or noted it on the IMF warnings about Brexit. What's the good side of Brexit? What's the bad side of Brexit? And what do you wish for?
Well, I think a lot of people around here don't recognize the current negotiations between the UK and the EU. They're negotiating effectively about the shape of the table they're going to sit at while they negotiate the real deal, right? So that's why I was a little perplexed at folks who were saying Brexit, that this is going to be a disaster right off the bat. I said, well, we're not there yet. We're not there yet. And it seems to me, I've always felt the premises of Brexit that seem to get, the premises on which Brexit got sold struck me as so misunderstood that it's hard to predict where this thing is going to go, because it can't possibly go where the people who voted for it thought it was going to go. Because if you say we're going to have to escape all those terrible rule makers in Brussels, well, a significant percentage of British exports go to the EU. And guess what? Those exports are going to have to meet European standards. So you can say we're escaping the standards. You can say, well, in what important way? Hopefully everybody is going to try to make this come out in a plausible way. And but it's not going to. But the main point is, it's clear there's not going to be a crash out, no deal Brexit. There's going to be a deal, but the deal is we're going to agree on the shape of the table. And then we're going to spend several years negotiating what the real deal is. So I'm remaining calm for the time being. What's the good side? I'm sure there is one, if I think about it. At any rate, anything
I
else?
think we have time for one more question.
I'll say one more.
Oh, one more.
One more.
Maybe I can just, you referred, John, to Robert Shiller.
Yeah.
And I caught him the other day and he was asked, why is it that economists can't predict recessions? And he said it's all about narratives, and he has a new book out
Yeah.
on the subject of narratives.
Yeah.
And he went on to say that President Trump has been very effective in promoting a very upbeat and positive narrative on the U.S. economy. Do you buy that argument as a long-term way of postponing?
Well, hey,
a recession?
he's got a Nobel, and what do I have, right? So, you know. I remember the reading Irrational Exuberance, and I kept reading thinking that this was going to be about, are the expectations of the productivity payoffs of technology overstated or not? And it turned out, no, it was all about psychology, what we say to each other. And I'd say, okay, but I'm not a psychologist. And it seems to me that I'd rather look and see what those productivity trends and profitability trends are doing, if that's what we're talking about. What causes recessions, it seems to me, typically are sick economies. And sick economies have imbalances. And typically, the sign of a sick economy that's going to eventually head into recession is accelerating inflation. And if just telling people that prices aren't going to go up, despite everything they see and think, is effective, well, maybe it is. But something in the water here and everywhere else in the advanced economies has convinced folks that inflation is going to stay low for a long period of time. That's why maybe one of the most striking graphs is that one showing expectations of sovereign bond yields, which it just, I think for most of us, seem just nuts. But that's what people believe, and that's belief certainly has a lot to do with inflation.
On that note, thank you very much.
Thank you all.